This is the MBK Beat with Mark Kostrzewski, your place for finding out all you need to know about life insurance and how you can get more out of your money. Coming live from Buffalo, New York, it's time for the MBK Beat with Mark Kostrzewski.
Hey folks, my name is Jeremy. I'm here with Mark Kostrzewski from MBK and Associates. This is the first installation of the MBK Beat podcast, where we will talk pretty much once a month on everything that is the word of life insurance in Western New York. We've been working together for a couple months now, do a little bit of marketing for Mark, and we thought this was a good idea to start talking a little bit more at length about some of these things, just because it's clear that every situation is different. You obviously can help a lot of different styles of people in Western New York. So we wanted to really just take a little bit of extra time and experiment, but also find out more in a longer term format in a podcast. And obviously it's something you see a lot more of around the country and the world. But we're experimenting, but I know that once we get into it, I know it's going to be really fruitful for everyone to listen, because I've learned a lot from you in the last couple of months, and it certainly has awakened me to some of the possibilities of life insurance that I definitely didn't know about personally. One of the things that we wanted to talk about today was Jim Harbaugh and Dabo Swinney and Ed Orgeron. A lot of the biggest names in college football in the last 5 years or so, a lot of those coaches have been incentivized with other packages that you may not have heard about. So split dollar being one big one. I'll sort of turn it over to you, Mark. We know that some of these big college programs are finding other ways to pay these coaches these large sums of money. Could you maybe just introduce us a little bit into what a split dollar plan is and why they might use them?
Sure, I'd be happy to do it. We've been doing it for a long time. Just a little background. Split dollar is a creature of IRS regulations. It goes way back to actually 1937, when the first split dollar plan was set up between an insurance carrier and a car dealership, I believe in Omaha, Nebraska, I believe. But in any event, it evolved over the years. In 1954, IRS issued initial regulations on how to treat these types of insurance benefit plans for tax purposes. And that was the controlling regulation. And it evolved in terms of its use and fine-tuning up until actually early 2003, I believe, where the IRS took another look at these plans and said, you know what, this has gotten too good. They really squeezed a lot of tax benefits out of it, and we think that maybe there's time to kind of bring this back in line, which they did. And so, long story short, we now live under those regulations with split dollar, and everything I'll talk about today kind of derives from the current regulations.
One of the primary things that obviously caught my attention was the ability that Harbaugh, Orgeron, Swinney, these other coaches, they are able to receive some of that income tax-free. I know that was one of the big things in my preliminary research that was sort of separation, why that might be beneficial for an executive versus some of the other traditional life insurance policies or even other executive benefits packages.
Well, the nexus of what they're doing is that, and this is really the key part of what split dollar tries to accomplish, is you're creating a supplemental executive benefit and future income stream, funding it with a life insurance contract that's designed to build up a lot of cash value. And under the terms of the contract and the tax code, you're able to distribute that money on a non-taxable basis. And by the way, the funding of those contracts, based on the revenue rulings I just mentioned too, provide a favorable tax treatment for the funding. So as opposed to getting W-2 income, only a very small portion of the actual funding of these contracts is taxable to the executives or the business owner. And ultimately, they're able to take out non-taxable distributions when they retire. And at the end, under this hardball plan especially, the university or the employer is guaranteed a payback of all the money they put in, and in some cases, even an interest accrual that they can apply to the premiums they paid in over all the years. So it's beneficial to the executive, it's beneficial to the employer, and oh, by the way, if someone dies in the meantime, not only is there insurance to repay the employer, there's a death benefit to the family that's income tax free. So these plans are not qualified like a pension plan. The only limitation you have on these plans is that the funding of these plans has to be reasonable, quote unquote, under the tax code with respect to the rest of the compensation package. So when you have these college coaches making these enormous salaries, they can be pretty big contributions, but it has to fit into whatever, whether it's a hospital executive, a business owner, a doctor. The funding of these plans can be pretty significant and very tax favorable, but you just have to make sure you're not killing the pig, so to speak, under the tax code.
The other thing that struck me was the lack of risk involved, because again, when I was sort of doing my own snooping around the Harbaugh case, it seemed as though some of that money, the big thing was, why would Jim Harbaugh want to play the stock market when he's busy coaching football? Or maybe a hospital administrator is busy, saving lives, or these executives are busy trying to continue working because they haven't necessarily reached retirement. But how does that come into effect as far as the low risk or where that money's going and possibly not losing that money in the stock market?
That's a good question. But just to give you some reference and background, a lot of these supplemental retirement plans are generally referred to as non-qualified deferred compensation of some type. Many of them were invested in the stock market without insurance, sometimes with what's known as a variable life insurance wrapper. But they did include a lot of risk, downside risk. So if the market went down 30%, you suffered that loss.
Right.
And it wasn't the employer's loss, it was your loss as the executive. But what you've seen with a lot of these supplemental benefits plans, especially with split dollar plans, is they've either been funded with a permanent insurance contract like a whole life policy with a fixed interest rate and a dividend on top of it, or what's really in the last 10, 15 years, a product called Indexed Universal Life, which is a permanent product with a floor, which is zero. In other words, you can't lose money, but you can earn upside tied to a stock market index. I can explain that a little more later. But these plans, those types of plans, do not have any downside risk. Now, I will point out there are a lot of plans out there funded with whole life contracts, projecting benefits. The problem with that product isn't the fact that you have a premium risk, you've got a risk of loss risk, but life insurance company dividends are predicated primarily on commercial real estate and long-term commercial bonds, and that kind of dictates the return to the insurance company, which dictates what you're going to pay out as an insurance company on this extra earnings. And anyone who understands commercial mortgages in general and bonds in general knows that those numbers have been dropping like a rock, and so have dividends. So there are a lot of plans out there, and I see them every day, especially bank plans, credit union plans, where people were promised stable returns, X benefit. Well, those numbers are not holding up in the least. So,
tell me a little bit more about that, because I know that obviously as we sort of transition into Western New York, in the landscape, the financial landscape, and obviously these are interesting times for anyone in the world right now. As far as the financial landscape, when it comes to business owners, when it comes to these smaller community banks, when it comes to credit unions, what do you have to say to them as far as what they should be looking at right now? Like, what's most important right now?
Well, from a product standpoint, the plus side of a whole life contract is you have a fixed premium, and you have a minimum rate of return, typically in the 3% range, and some type of dividend that adds to it. could add another 0.5% or 1%. Used to add a little more than that, but those, like I said, those numbers are coming down. But when you compare that to a bond account, if you're going to buy insurance, if you need insurance and you're going to save money, when you compare term insurance on a bond account to a whole life policy, you're much better off with a whole life policy. No question about it. That's not the issue. The issue is when you're trying to use these contracts to fund more than just an alternative bond account or savings account, how does it stack up to alternatives, or how is it performing becomes the issue. Well, it's not a good or bad thing. It says, is it the most, it is what it is, but is it the most appropriate thing? For example, a 747 is a great airplane to take people to Europe, but maybe it's not the best plane to go fight a dogfight.
Right.
Okay.
Right.
So it's just, is it the right plane to use? But getting back to split dollar, there are 4 areas I'm seeing a lot of activity in. Individual businesses and professional situations, 501c3 organizations, credit unions, and banks, community banks especially, privately held. Let me make a couple of comments about each of them.
Yeah, absolutely. Please do.
Well, in individual situations, and I'm dealing with a professional situation right now, it's an S corporation, and these are 2 highly compensated physicians in a practice, and they're funding insurance to fund what's known as a buy-sell arrangement if one of them should die or become disabled or leave or get a divorce or retire, what have you, various contingencies. But from the death benefit standpoint, you're typically using life insurance to fund that agreement, so the survivor has the money to pay out the widow's or the widow or the professional's estate if he dies. Now, that life insurance solves that problem. Well, what if we are to add cash to that policy, or cash value,
Right.
and build up that cash and create a way to monetize part of their practice and create an income stream at retirement, and also fix the premium so you don't have a rising premium like you do with term insurance or an end of the coverage. Permanent coverage with a fixed premium to take care of the buy-sell agreement, but also we're taking money otherwise that would be W-2 income to them and creating some tax benefits there, building it up tax deferred, and being able to pay it out on a non-taxable basis when they walk away as part of their distribution from the practice. That's appealing to a lot of business owners.
And that's younger business owners, people in Buffalo that haven't really.
Yeah, people that have they've gotten past stage 1, startup survival. Now they're making money and they're trying to really create some wealth and monetize that business or practice. This is a piece.
For the long run. If they're going to be in it to win it for the long run, it's a good idea now. If it's tax-free, it seems like a no-brainer to me.
And with all the money that's being spent these days on COVID and our deficit, anyone who thinks taxes are going to stay low forever, no one believes it. So nice to be able to get money out non-taxable, on a non-taxable basis.
Especially for a young, or even not young necessarily, but a young business, not necessarily a young individual, but even just a business that hasn't been around for too long.
Well, once you've got discretionary cash flow, you're making your investments to grow your business, and you're trying to take some money off the table, this becomes part of the conversation.
When you're ready to really go to work.
And it's not unusual that I'll see young professionals or business owners, and we get started with term insurance, and one of the nice things about term insurance, in addition to a little premium for death benefit initially, is if you're dealing with a good product with a good carrier, you can convert it to some of these better products.
So you could actually take whatever they're doing now, if they were to start working with you, they can just basically take whatever they're doing and be able to transition some of that into what you're talking about.
Right, and there are half a dozen decent carriers with products you can convert to. There's some term products that are just cheap term that's the only reason these companies exist. But there are a variety of companies that have conversion products and privileges in their term policies that make it here we need to solve the basic problem if something happens to somebody. 5-6 years later, well, we've got discretionary income. This makes a lot of sense. So individual business owners and professionals, we see some split dollar with that as well. And also on their key employees. It's a way to structure a plan where you're providing some insurance for the executive's family, you're putting some money away, and essentially you can create a vesting schedule to hold on to these people so that, you want this benefit, you're going to have to stick around 10 years. So it has a lot of use in the corporate and the professional market.
I remember hearing, to sort of bring back in my layman's terms again, the Harbaugh. I just kind of go back to the Harbaugh plan. I did remember reading also. It was almost as if the longer he lived, the better off his beneficiary would be financially. How does that play into the effect as far as like how long someone lives versus?
Let's get into the Harbaugh plan. And, they're a 501c3 organization.
Okay, yeah, because that's a great transition. Perfect.
And your top executives at hospitals, not-for-profits, large not-for-profits, they're funding supplemental retirement plans as part of the compensation package to be able to recruit the talent you need, not just football coaches,
Right.
but the CEO of the hospital, the university, et cetera, to get them to come and stay there and give them a tax-efficient payroll package. It's not all based on W-2 income. And most of it's a non-qualified deferred comp, and a lot of it's under a code section called 457F. Split dollar works a lot better for these executives, in my opinion, for a couple of reasons. Number one, under the traditional 457F deferred comp plans, the executive is not vested in anything until he leaves. Number two, when they leave, he gets everything at once. He gets all the money in a lump sum. It's fully taxable. All right? And it may be structured so that there's a refund to the organization. But, is there a better mousetrap? Additionally, into the basic issues I have with those plans. I mean, if you don't have anything else, that's what you do. Or if you don't know better, that's what you do. I just shipped some golf clubs out to my son in Seattle, and it cost me $170. And someone said, "Why didn't you use ship sticks?" You could have saved $100. Well,
I would have. Now, were those your old golf clubs? Because I know you said you got some new ones. Did he get the recycled?
He got the ones that are 3 years old, which are a lot better than the clubs he has. So
I'm sure,
he can't, and he just moved next to a golf course, so we can't wait.
Oh, so I'm sure you'll be out. You'll have to ship yourself out there.
No, well, once we can go there, once all this COVID thing's over. But
Right.
but having said that, another thing happened last year with the tax law change. When the Tax Reduction Act was enacted, they enacted an excise tax that impacts these plans. 4960 of the Internal Revenue Code that says, when I receive my 457F plan, and a lot of these have big account balances, $500,000, $1 million, $2 million, that money is lumped in with my salary in the final year. And if the total amount exceeds $1 million, there's a 21% excise tax to the university or the school. So let's assume I'm an executive and I'm going to get $3 million.
Organization gets 21% tax on that.
On $2 million. They're going to have to come up with a roughly 20% tax on $2 million, and nobody knows about it.
To the federal?
To the federal government. Now, the employee's already paying his tax, but on top of that, there's a new tax to the organization, and nobody knows about that. So, we're looking for these plans and saying there's a better way. Mm-hmm. In other words, you can structure a split dollar plan, okay? And there's two types of split dollar plans that one of them will fit into other state laws. Sometimes there's some conflict on how these plans can be funded under state law for not-for-profit institutions. But there are two versions of split dollar. One of them will work in a not-for-profit situation, depending on the state you're dealing with, and allow this to be funded, create some investing without current taxation, and create a non-taxable benefit at retirement, and guarantee a refund to the organization without this excise tax.
And the organization doesn't get cut out on
Right.
the 21%.
Right, right. So there's a lot of opportunity there, in my opinion. And, most of these organizations that have set up these plans have been doing it one way for years because that's the way you do it. We go to meetings all the time. We get on a plane. Well, guess what? Now we have Zoom and Team 360. It's changing the world.
Right.
We all went to the office. Well, I guess that's not what everyone did. Well, COVID's done a lot of things, but it's accelerating a lot of change in the way we behave, but also the way we think.
Mm-hmm.
And I think, that's what I think they need to really look at the paradigm, because there's a real paradigm shift with these plans, given what I just said.
Yeah.
Okay?
Yeah, that makes a whole lot of sense. And I think, obviously, for any larger organization or, smaller upstart ready to take the next step, from everything you're telling me, it sounds like the way to go, especially if you have to have life insurance. Now, talk a little bit about, I know that was the 501c3. We've talked a little bit about individuals. How do community banks fit into the mix? Is this sort of in line with finding the best level talent where maybe a smaller community bank might not have the incentives that some of a larger corporation might have?
Well, commercial banks are looking, management talent is really the key to growth and success in any organization. It's not just my humble opinion.
Right.
But, you see it in athletics all the time. Why does someone like Saban win wherever he goes? The Miami Dolphins notwithstanding. Okay. Why does someone like Lou Holtz, wherever he went, he won?
Mm-hmm.
Okay. How does someone like Tabo, what's his name?
Dabo Sweeney.
Yeah. Well, he takes a losing program, turns it into a national powerhouse on a sustainable basis. Mm-hmm. It's coaching talent, leadership skills, etc. And so, any organization that's going to thrive in a competitive environment needs top-notch talent. And commercial banks, they're if you take like in Buffalo, M&T, they attract a lot of talent for a lot of reasons. But one of the reasons is because of their stock option plan.
Mm-hmm.
There are a lot of people getting rich off their stock options. That's a big part of the compensation package. But what if you're a non-public bank? You're not traded.
Right.
Okay, or you're a small bank where you're not going to get the kind of growth stock-wise that you're going to see in unless there's a merger or an acquisition,
right,
like an M&T. Well, how do you recruit real talent? And there are people who don't want to be part of a public company, but it's hard, to turn down some of those opportunities. Well, split dollar plans are deferred comp plans in general, but split dollar plans can also be used with community banks to create the exact same incentive. You create some huge retirement benefits, tax-favored treatment, and a significant estate benefit for their families, and essentially have a built-in vesting schedule into these plans, the way they're structured. They're referred to as endorsement split dollar plans that banks can utilize. So, and a lot of banks don't know these types of plans are available. So that's a way to compete, to create a recruiting incentive with a benefit that competes with stock options if you're not a public company. So those are banks. Now, I'll segue right into credit unions as well. Credit unions have been using split dollar for a number of years. People I work with, have worked with in the past, some 25 years ago, developed a split dollar strategy and got it approved by the NCUA to actually fund these types of benefits for credit union executives. Because obviously they're not for profit, they're not issuing stock and so on. And there are a lot of plans like this out there that provide these supplemental benefits with vesting, with tax-free income, with a big estate benefit for the family, and a return of premium and interest to the credit union. Everybody wins. And a lot of those contracts, they've been funded with different types of insurance products, but I would say overwhelmingly whole life contracts. And the issue there is a lot of people have been promised a benefit 5-10 years ago, and those benefits just aren't holding up. And there's some things you can do internally, redesigning some of your assumptions for the bank to mitigate that. But it's when the long-term returns are dramatically reduced, the long-term benefits to the executive are reduced. The credit union is never at risk because they're going to get their money back. That's the way these things are structured. We, the credit union, get the cash and or the death benefit back all the time, plus any interest that we're accruing on this loan. And whatever's left, that's what the actuaries figure out the benefit from, and it's a shrinking number. And there are ways to restructure that with products that are performing better in this financial environment. Primarily, in my opinion, index products where you have a policy with premiums and cash values that are never at risk, but instead of paying you some type of an interest rate, the insurance carrier takes your earnings they're making and buys options on the S&P. And if the S&P is in the money, you're going to make some significant money. And you don't illustrate big numbers. You illustrate 5.5%. And these contracts have typically, they've been around for between 15 and 20 years. And most of these products have performed about 7.5%. And we're usually showing about a 5.5% projection. What can we do with 5.5% versus an existing product? Frankly, we can do some real remediation to some of these plans. But you've got to be insurable. You've got to have some time to make it work. So it's not a panacea.
Right.
And in some cases, I look at these plans, and I'm looking at some right now. It's really just a matter. We've got people with health issues. We can't really do a lot. It's all about stopping the bleeding and seeing if we can maybe put a little more money away for them, changing the interest rates for the credit union. So you got to tinker around the edges. But there's a lot going on with credit union plans right now.
Yeah. So we're gonna keep doing these, and this has been awesome. I've had an awesome time. What would somebody, if they wanted to get in touch with you, what would be some of the first questions you would ask them if they wanted to sit down? What would be just a few of the opening questions you would have for them? And then how long do you think, roughly, maybe I'm sure some people are probably a little intimidated by digging into some of these things, but obviously we've talked about the time is now with the uncertainty of the market and taxes and the future generally. If someone was a little intimidated about getting into something like this, what questions would you have for them, and what comments would you have as far as sort of calming that concern or, taking that first big step?
Well, this is really about having a conversation with people. And I don't care whether you're a business owner, a professional, or a bank executive, or someone getting ready to retire for that matter, we do a lot of work with people, pre-retirement people. But the first question is, tell me about your current situation. Where are you? What are the details of your situation, your economics, et cetera. What are you looking to do in the next 5 to 10 years, whether it's as an individual or as an entity. Mm-hmm. What are your concerns? And the first thing is, can you work with somebody? Do you like them? Do you trust them? And frankly, do they fit a profile? Because I can tell somebody after having a productive conversation, whether it's over a cup of coffee or lunch, getting some information, kind of a soft fact finder, whether or not they've got issues that I can help them with.
Right.
And our whole approach is, can we add value? And I'll say, I think, there may be some things, for example, I'll give them some thumbnail examples we might be able to help you with, but we'd probably have to get a little more detailed information, and you probably need a little more education. And then you're into step 2. And then, if step 2 makes sense, you get more detailed information. And if you're starting to look at, maybe we need to look at some supplemental executive plan proposals, take a look at what you have or don't have, that's going to accomplish this or fix that problem. And then, does this make sense? Does it look good? And then, how's the decision-making process in the organization done? Who do we need to get involved with this? uh, uh, number 5, what are the details? What kind of legal issues are there you have to deal with? Accounting issues? Are there bank issues? Are there state tax issues? You have to kind of cover the landscape. And once you've kind of addressed all those issues, and you're trying to build a consensus that, okay, we're on the page. We're a legitimate candidate. This makes sense. This fixes a problem. Addresses an issue. This is the best solution. We can afford this. Boom, let's get it implemented. And once you get it implemented, then you've got to manage it and administer it. So we have a legal backup to do the necessary documentation for the organization. We'll work with their legal counsel. We also work with third-party TPAs that are going to be around a lot longer than me to make sure this thing stays in compliance. Okay, so that's kind of the process.
Yeah. No, that sounds awesome. Was there anything else that you wanted to sort of talk about today? Because we'll be back for another episode.
No, except I'm looking to use my new golf clubs this weekend.
Yeah, I still haven't been back out, but my buddy has, talked a little smack about 3 times since the last time, and I've got my mom trying to get me out on the course now. So,
well, it's not just about the arrow; it's about the quote Indian or American Indian. You got to be able to make a swing.
Right.
And but if you can make a swing, technology makes a big difference.
Yeah. So what are your new clubs? Tell everybody just a little bit of, unless you don't want to. Now
they're the hottest selling clubs in America.
Oh yeah. So what do you got? You just got some new clubs, grips.
Yeah. They're the Callaway Mavericks, and I started with the driver, and I said even my bad shots are going 40 yards longer, but the good ones go a lot farther. And I said, gee, let me try the 5 wood. Let me try the, and I was just going to put it in my bag. After about 2 weeks, the pro said, let's measure you up.
Yeah, why not?
Yeah. But, the other ones I had weren't bad. But, the first time I ever really got custom fitted clubs. And it does make a difference, so we're not here forever. Let's go for it. So,
first time ever getting custom?
Oh, yeah.
Wow.
I used to go to Golf Galaxy and just buy things off the rack. And,
yeah.
Technology is better. But, should you need a longer club? Do you need to change the angle? How does it feel? What kind of shafts? I mean, when you really get into it and get into all the details, it makes a difference.
Yeah.
So, still working on my handicap, but more importantly, my swing. But yeah, so I'm having fun.
Awesome. Well, I've had an awesome time today. I think that's good enough for today because we're going to have more to talk about in the next episode. So we'll see you in a few weeks, Mark. Hopefully we get a couple more weeks of golf weather here.
Couple more weeks. 2 more months.
All right. Well, thanks, everybody. We'll see you again in about a month for the second episode of the MBK Beat.